Good morning from London, everyone, and welcome to this panel discussion convened by OMFIF and in partnership with Sustainable Fitch, discussing driving sustainable investment and climate resilience, where we'll be looking at the challenges, the practices, and the opportunities for financial institutions. I'm Emma McGarthy, head of OMFIF's Sustainable Policy Institute, and I'm joined today by Jerry Cross, who is Director of Financial Regulation, Policy and Risk at the Central Bank of Ireland, Anita McBain, who is Managing Director and Head of EMEA ESG Research at Citi, Carmen Nuzzo, who is Head of Fixed Income at the United Nations Principles for Responsible Investment, Shiori Takashi, who is Deputy Director at the Financial Services Agency of the Government of Japan, and Andrew Steele, who is ESG Lead at Sustainable Fitch. So welcome to you all, and thank you so much for joining me today. Just a reminder to our audience, please put your questions in the Q&A box and I'll endeavour to put them to our panellists when we have the opportunity. So thank you again to our panellists, lovely to see you here. I'm going to open the discussion with a question, which I'll put to each of you, and you can use that opportunity also just to talk a little bit about what your organisation is doing in this space. But my opening question, just to kind of set the scene, get things going, is what is the latest in sustainable product development where are we in growing sustainable financial markets and investments? And Carmen Nuzzo, can I go to you first? Lovely to see you. Thank you for joining me.
Yes, thank you. I'm delighted to be with you today. So let me say very quickly that for those of you who do not know what the Principle for Responsible Investment is, we are the largest global investor movement promoting the incorporation of environmental, social, and governance factors in investment decisions and asset allocation. We started our activities in 1996 with only 100 members, and now we count with over 5,000 members, the majority of whom are asset managers. We have a growing portion of asset owners as well, insurance and pension funds, and also some service providers, including data, information providers, and credit rating agencies. So we've seen a huge evolution since the onset of the PRI in sustainable finance. I would say most of our signatories, especially the ones I work with within the fixed income program that I'm responsible for, need products and support to implement two different approaches that they adopt when incorporating responsible investment approaches in their investment decisions. So some come at this for risk mitigation purposes. So they use ESG factors to assess the probability, particularly in the fixed income space, that they won't see their money being paid back on time and in full. So the probability of default of an issuer, be it a private issuer, private sector issuer, a corporate issuer, or a public sector issuer, like a sovereign or a sub-sovereign entity. But others increasingly are interested in buying products that are labeled ESG, products that have a specific purpose, either a project or they're linked to a sustainability target of an issuer. And these are very helpful instruments that can help both the issuer and the investors to focus on a specific environmental or societal outcome. I really like to use the word outcome because we really encourage investors not only to produce positive outcomes for the environmental society, but also to work with entities to reduce negative ones. And so in the last few years, we've seen really a lot of dynamism in this market. I would say it's been very creative in terms of products that we've seen. Particularly, we started off with the green bonds that were launched many years ago, but have really taken off in the last 5 years. But in addition to the green bonds, we've also now seen in the market the social bonds, the sustainability bonds, the sustainability-linked bonds, and there's also been a lot of activities in the loan space with sustainability-linked loans. And it's really important for investors to do their homework, because just buying one of these products doesn't make them any more responsible than those who buy mainstream products. So we really encourage them to do their homework and understand what they're buying into, and also not encourage them only to buy these products to support sustainable finance, but also work with entities, with issuing entities in their mainstream funding, which remains the bulk of their financing needs. So perhaps I'll stop there and I'll give the floor to the others, and I look forward to continuing the discussion.
Thank you, Carmen. Yeah, and indeed, I think we'll delve a little bit deeper into the latest in sustainable product developments, and interesting to kind of hear how investors can work closer with issuers as well. But Anita, maybe I can now turn to you for this opening question of where you think we are in kind of growing sustainable financial markets, and investments. And love to have you joining us.
Thank you and good morning, and it's a pleasure to be here. So my name's Anita McBain. I'm head of ESG research for EMEA here at Citi Research. So we speak to investors on a daily basis. I myself actually have a fixed income background. So Carmen, it's really encouraging to hear what you're saying there. So we're certainly seeing the emergence of a very sophisticated nucleus of investors that have pushed through the data barrier. We used to have a lot of questions, just shrugging their shoulders, we don't have the data. We as ESG analysts, we operate in a world of non-traditional data. But a lot of this non-traditional data we're now starting to see integrated into the annual reporting. So here at Citi Research, we write research on all the big topics, whether it's climate, what are the specific climate metrics that investors should focus on, scope 3 emissions, carbon pricing, biodiversity loss, for example. And we're certainly seeing investors very keen to engage on these topics, as Carmen said, not just to understand the risk mitigation, but to understand how resilient the companies, their portfolio companies are in understanding these risks, the future risks to their business. And we're talking about single and double materiality. The world has fundamentally changed. So how are they thinking about complex global supply chains, the impact of biodiversity loss, how dependent they are on biodiversity, impact of climate change? So the conversations that we're having, Emma, are moving very quickly. We're certainly seeing the arrival of, for example, this era of data superabundance, geospatial ESG. This leans very much into what Carmen was saying, actually. We're finding a lot of fixed income issues are like, how do we use this data? A lot of equity investors, how do we use this data to understand the complexity of supply chains, transparency, traceability? And I'd like to pick up on a point that Carmen made about outcomes. Engagement, which used to very much sit firmly in the domain of shareholders, engagement. We're now starting to see the democratization of that, debunking this as being an equity-only occupation, certainly seeing fixed income investors willing and keen to engage with their portfolio companies or their issuers. So this piece that Carmen mentioned, I just want to touch on that just very slightly. We talked about the regulation that you mentioned it. What are we starting to see? We're certainly seeing this need to evidence engagement with an outcome. And what does that outcome look like? The market is now looking for credibility, is looking for evidence of that strategy. How does that environmental strategy lead to an outcome? So I want to pause there. I know we've only got an hour today and to allow everyone else to speak, but thank you very much. And it's a pleasure to be here.
Brilliant, thank you, Anita. And yeah, lots to unpack there, and I think lots of things that we'll go a little bit deeper, especially the data issue, shareholder engagement. I think all excellent topics and things that we'll definitely go into. So thank you. Zari, maybe I can go to you next for your opening remarks and where you think we are in growing sustainable financial markets and investments.
Thank you, Emma. It's very honored to be participating in this panel with you all. My name is Saori Takahashi. I'm working for Japan Financial Services Agency, focusing on international affairs on sustainable finance. So participating in a lot of international meetings on sustainable finance, including NGFS and some of the OECD meetings as well. I focus on climate area as well as biodiversity, representing Japan FSA for the NGFS task force on nature-related risks. And recent development and the market trends, I would definitely say that not only Asian market or Asian stakeholders, but also European stakeholders will be are talking a lot more about the transition finance recently, and the Japanese government has tackled on in terms of the transition finance in terms of a lot of policy measures. Along the line, we have published recently the discussion paper, the supervision guidance on climate-related risks and client engagement. I guess back in July. And also we've done and published the pilot scenario exercise for the major banks and insurance, in companies in Japan. And I guess that goes all back to the strategy that I guess Anita has just briefly mentioned, whether the corporates will go from here to 2050, and also the perspective on the how the clients would be engaging with the financial institutions, that financial institutions therefore could eventually reduces their financial risks. And I guess the data would be as well be paid a lot more attention, which would be, I guess, a lot more. Those are the topics that I think will be really important. I mean, data issues will be sort of recently gotten into sort of the policy discussion as well. And I understand there are a lot of research activities going on in the data sphere. So I would be happy to hear a lot from the market participants in terms of data issues as well. Thank you so much.
Lovely, thank you so much, Ori. And again, lots that we can touch upon from that as well. And interesting to hear your role at the NGFS biodiversity workstream too. Andrew, maybe I can go to you next for your introductory remarks and just a sense of where you think we are in growing sustainable financial markets and investments.
Thanks very much, Emma. So I'm Andrew Steele. I'm the ESG lead within the Fitch group, and just a little bit of background from a sustainability perspective. Over 4 years ago now, I worked and created the integration of ESG factors into all of our credit ratings across all the asset classes, and then more recently set up and created a business division to produce ESG ratings. And the way that we look at this as a credit rating agency is on the regulated side of the business. We look at financial materiality related to the credit rating forecasts from an ESG perspective. But then to the points that both Anita and Carmen raised in the ESG business division that looks at pure ESG analysis, there we look at impact and outcomes and overall performance from an environmental, social and governance perspective. It's fair, and I think we'll talk about that later. It's very important to distinguish between those. So the question was where are we in growing sustainable financial markets and investments? And I think we've come an enormous way in a very short period of time. And a lot of that has been facilitated by a much more in-depth dialogue, I think, between asset owners, investors, and financial market participants like ourselves. And in no small amount due to organisations like Carmen's, the UNPRI, and bringing people together, and yourselves, Emma, in bringing people together to discuss these issues. And I think that really has helped move the market very fast. In terms of growth, there is more appetite and demand than there is supply, for definite. And whenever that occurs, you have a lot of financial innovation in markets. And we've seen certainly a lot of that. And I think we'll talk about some of the interesting products a little bit later on. But that can lead to problems. And I think the main point I'd like to make in response to the question of where are we is I actually think we're at a critical juncture where the sophistication of structuring is actually starting to outstrip fundamental data. And it is catching up on the data side quite fast. And we are seeing a lot of initiatives. And I think one of the best that we're seeing is the ISSB that is out there. But when that happens, there is quite a high risk. And I think it's a pretty risky period that we're entering, as the level of estimation in data can often be glossed over or forgotten, and people can see figures on paper and just assume that they are correct. And if you're not careful, what this can result in is it can result in inaccurate or misleading outcomes. So really what we need to be trying to ensure is that the fundamentals that the analysis is based on are very clear and well understood by those consuming the end products. And I think at the moment we've probably reached a juncture where the sophistication of the products is pushing ahead of that a little bit. And I think that's one of the reasons why regulators start to become very interested in the markets at that point, because what they can see is they can see a lack of clarity for the end users. And also, it's very, very important that if we are trying to achieve true impact and outcomes, particularly as we're time bound and moving towards solving some of the climate risk aspects, that it's very clear what you're actually doing, because otherwise it can sound very good but achieve very little, and in the meantime the clock ticks down.
Yeah. No, thank you very much, and very good to hear the sense of that appetite developing and growing. And I think the conversation of data is definitely one we'll have to dive into. This seems a recurring theme. But Jerry, maybe I can go over to you now for your introductory remarks and your thoughts on where we are in growing these sustainable financial markets and investments. Thank you very much.
Thanks, Emma, very much. And look, thanks for the invitation. Great to be here and to be part of this really important discussion. Central Bank of Ireland is a fully integrated central bank and financial services regulator. So we go across the full range: banks, insurers, securities markets, investment funds, etc. One of the things that means is that we participate, picking up what Sari said, we participate in a range of international, the NGFS, IAIS, the Insurers Association, Sustainable Insurance Forum, IOSCO, the Securities International Organization, and European bodies, the European Banking Authority, European Insurance and Occupational Pensions Authority, ESMA, the full range. So I say that to mention how much activity is going on in this space, and that I think is one of the challenges, that it is such a broad swathe of regulatory advance that we're trying to achieve, that in itself is challenging, but obviously a very, very positive challenge to have. Let me, so the question, where are we on the journey? I really want to pick up on kind of where Andrew left off there. Look, I think we have made amazing progress, right? From where we were, and again, I look at this from the point of view of sort of the financial system and the financial regulators. From where we were, let's say 7 years ago, when Mark Carney sort of took up the cudgel and really brought the financial system wholly into this space, but from a very standing start. I think we have made great progress, but it's a journey. And I think we are sort of, the metaphor I would use is if we're trying to get to the somehow to the sunny uplands, we're kind of going through a forest at the moment, and going through a forest is where the dangers lurk. And I'm kind of with Andrew on that. I think there's lots of risks, lots of progress, but lots of risks. And when you're going through the forest, amongst those risks are, first of all, simply that we lose our way, right? There's so much going on, and how do you keep to a clear path? It won't be a straight path, but to a clear path, and avoid the sort of the pitfalls and the side tracks. Secondly, the danger is that we're too slow. We get to our destination too late, and the problems have gone. I mean, I really, really think the scenarios that have been developed by the NGFS, the Network for the Greening of the Financial System, are really powerful heuristic devices. So there's three broad scenarios. Either we end up with sort of a global hothouse, we're just too late, or we get it broadly right and we have an orderly transition, or, and this is the most likely one in their view, that we have a disorderly transition, that we leave it all and then we try and do it all in the last 5 years, 10 years, try and make up ground, and we find ourselves in a very, very disorderly context. And that, of course, is something that we want to avoid. So there's that whole risk around just being too slow. And then I suppose the third thing, so you can lose your way, you can go too slow, or you can just find that you're not up to the task, right? And that's the one from a financial regulatory point of view that we are really focused on as well. How do we ensure that the financial system, financial services, and financial regulators are up to the really, really significant task, existential task, that we are faced with here? And in that regard, I think there's sort of, again, picking up on what's been said by others, to my mind, there are three big pieces that we need to get right. One is capability, right? There is a massive, massive demand for the people with the expertise and the technical ability to help us, financial services folks, get to where we need to be in a very rapid order. So we really need to focus on the training, the development, the capability developed. Secondly, and I won't delay on this because we're going to come back to it, but data. Of course, the data is a real challenge, and I think how Andrew described it there, sort of the potential for our demand and on our structuring engineering capability to outstrip the available data, I think is really, really, really. So we'll come back to that. And thirdly, and again, really important for me, a focus on confidence and trust. We know in the financial system that trust in your financial services provider, whatever the type of financial services, is at the heart of this. I think there's a real risk in this massive swathe of activity that's underway, is that financial services lose the focus on being at core trustworthy partners in this journey, to being sort of eye on the profit opportunities that are there. Both of those things can go together, but really, really important that we really focus on that bit of trust and confidence. And I'll say more about that later on. Final two thoughts for me. In all of this, given the complexity, given that we're in the middle of the forest, given that we need to get to where we want to get to, two things we need. One, pragmatism, right? We have to avoid looking for perfect solutions. We won't find them. So progress is better than no progress, even if it's not perfect progress. And secondly, I come back to that point, we need commitment and we need confidence, and we need to be able to be confident that the way the financial system is approaching this is the right way, that they're coming at this in partnership with society to get us to where we need to be. And that's the real challenge for all of us, for regulators and for the sector. I'll stop there. Thanks, Emma.
Wonderful, thank you, Jerry. Yeah, again, lots to unpack there, and I think we'll delve a bit deeper into the role of the regulator shortly. But I think maybe just to take a step back slightly, just to talk about, and this is something that Carmen touched upon at the beginning of her opening remarks, is where we are with sustainable product development and where we are with issuance, and perhaps in particular looking at investment funds, exchange traded funds, and kind of where we are in the development of these financial products. So Carmen, maybe I can go to you first, and we can go a little bit deeper into kind of what you're seeing there.
Yeah, sure. With pleasure. I also would like to react to a couple of remarks that were made earlier that were very, very interesting. First, let me say that the two outcomes that I described earlier, the risk mitigation and the outcome-driven approach, are not mutually exclusive. And so we are seeing in the market a flurry now of products that are coming to support both sides of these approaches. The problem is, as Andrew said, that sometimes there is lack of transparency behind these products. And so the numbers or the scores that are produced may seem very glossy or a quick solution to the analysis, but people need to go deeper and understand the products that they're buying into. And for that, there is, on the one side, I really like what Anita said, a superabundance of data, because we've gone from having very little data in certain areas to too many data, and then people don't know which are the financially material ones, which are the ones that are needed to respond to regulatory requirements, for example. So data are used for different purposes as well, and we have lots of data, and we have to discern what they're used for. But also at the same time, we need data to ensure that investors and whoever is buying these products can assess how genuine these products are and how veracious they are. And we're not quite there yet because we don't have standards. And if anything, we have a plurality of reporting frameworks that are competing. The issuers, borrowers, and equity issuers are very fatigued because they have to report to the TCFD, to the CDP, to the GRI. The investors have to report to the PRI reporting principles as well. And they answer perhaps many times again the same question that is just worded differently. So this is creating a lot of fatigue in the market. And service providers, to your point, Emma, when it comes to ETF indices, for example, ETF products, have a big responsibility in making sure that what they sell is transparent enough for investors to have that degree of confidence that they're actually making a difference by buying a certain product instead of making their own analysis. So it's really a dual responsibility, I would say. On the one hand, those who develop products have to be more transparent, but on the other hand, those who use the products have to increase their scrutiny in what they're buying into. And I wanted to just come back very quickly to one thing that Andrew said about the difference between ESG ratings and credit ratings, because at the PRI, we've been running an initiative since 2016 that Fitch has also been supporting since 2018, called the ESG in Credit Risk and Ratings initiative, whereby we work with many credit rating agencies, 27 and over 180 investors. And during the conversations that we've been having, connecting credit rating agencies and investors, it's become very clear that there is a huge confusion between what credit ratings measure, to the point I was making earlier about transparency, and what ESG ratings measure. And Andrew explained it very clearly. You know, one is about the ESG profiling of an issuer, and it's a tool that is needed to assess the credentials, if you will, of an issuer, whereas the other one measures the probability of default. So these information and talking about these differences is very important to equip investors with the right tools to make the right analysis. And I also wanted to react to, Jerry, I'm going to steal your simile of the forest, because I think it's very powerful and very, very descriptive of the challenge that we have ahead. But I'm hoping that we can see the light at the end of this forest, and that we're not completely in the dark. To your point about building capability, that takes time, and we don't have much time. So even with product development, Andrew was saying earlier that demand is outstripping supply. What we need to do is really convene different stakeholders, and this is a great venue to do this, because we have different representatives from different angles of this puzzle, if you will. Because through these conversations, we can fill together gaps and accelerate the solutions to fill in those gaps. We got really much out of the conversations that we facilitated between investors and credit rating agencies, and I really like to think that Fitch is. It's not by accident that Fitch that Andrew set up his new department back in 4 years ago, because he started working with us on this project. But since then, we've also facilitated lots of workshops with borrowers, credit rating agencies, and investors. And we're planning to do that also with the regulators, with central banks, and so on. And actually, these have been an amazing venue for facilitating a dialogue, for engagement, to provide engagement opportunities, but also to come up with emerging solutions that we're communicating to the service providers and the data providers that are putting together these products that should be facilitating investors' jobs. So perhaps I'll stop here.
Thank you. Andrew, do you have anything to add to that from the ratings perspective? And also, as Carmen touched on, you talked about the innovation that's happening and kind of supply being outstripped by demand. How can we rectify that? What innovation are you seeing in these products? And yeah, adding to what Carmen has said.
Yeah, I mean, I think one of the difficulties for investment funds and exchange traded funds in particular, and it comes to something that Jerry mentioned as well, is that it's when you're managing or you're controlling an entire fund, the depth of information from an ESG perspective on the assets that you're holding within that fund can be highly variable. And that then makes it very difficult to provide an accurate view of what the fund is actually achieving. And that comes back to Carmen's point about, how can you actually see whether what the fund says it's going to do is what is actually happening, and is that the impact that the contributions to that fund are actually making. And that's where, from a regulatory perspective, it's not surprising that the regulators are interested in this, and there is a huge amount that I think they can bring to the table. I think Jerry's point about the expertise and having that breadth of expertise is one that is really underestimated a lot of the time. I mean, when we set up the ESG ratings division, we very deliberately went about recruiting people with very specific technical backgrounds, because we were interested in analysis of fundamentals and going into a lot of detail, not data scrape scoring. I think the time for data scrape scoring has probably passed in this market. And we've been recruiting people who are lead certification building experts. We've recruited people from the mining industry who are experts in mitigating carbon emissions through operational processes. We've recruited people who worked in the airline industry who were responsible for carbon emissions management from a fuel perspective, because when we looked at this, we said what we don't need is a bunch of financial analysts trying to sort this out. What we need is a bunch of people with that expertise. And it was very interesting. I had a discussion with one regulator in Asia, not Sayori's. I have to say, I had a discussion with one regulator in Asia who was contemplating whether they should mandate who could be qualified to be an ESG ratings person. And as we were having that discussion, they asked us, well, what do you think? Should we determine what skills somebody should have in order to be able to operate in this market? And I said to them, well, I really don't think that's a good idea, because the more diverse a set of opinions you have, the better your outcome is likely to be. And they actually asked us for an example. And one thing that amused me greatly was one of their team had just joined, or was just about to join us. So even the regulators are shifting around in all this. But I think the most important thing is innovation, accuracy, and detail. And just to give you an example of the types of products that are coming out, we recently did an ESG rating on a sustainability-linked bond, which was on the securitization of end-of-life gas assets. Now, the SLB itself had a very strong purpose in terms of reduction of methane leakage, but you can imagine the entity that owns that type of asset in that type of industry, and it was an industry player, not an investment fund. The view on impact and outcomes for that entity is, from an ESG perspective, and its overall operations was extremely poor. But that instrument in itself was very worthwhile in terms of the additional contributions that it was going to make. So it's back to Carmen's point. If you're going to start to look at product development and issuance, you've really got to understand the detail of individual instruments and whether or not they align with an entity's strategy, whether or not they're contributing to transition if the entity needs to transition, or if the entity is completely altering its business model, how much they're contributing to that and whether they're aligned with that or not. And it does make a difference. So the devil, as always, is in the detail.
Yeah, no, thank you. And Jerry, I will come to you on the role of the regulator, but perhaps first we can go to Anita for your reaction to this and kind of where you think we are in terms of product development and issuance, and also perhaps how we can build more resilient and sustainable portfolios and measurement tools as well.
Thank you, Emma. And we particularly like the word resilience here. We're certainly hearing and seeing that when the narrative is now moving on from a narrative around risk to a narrative around resilience. So how resilient are our food systems? How resilient is the energy system? How resilient is the water system, bookended by climate change and biodiversity loss? So how resilient is our climate system and how resilient are our ecosystems? You see where I'm going with this. So and at the core of that sits human security. So we're certainly building these ways of framing this risk to resilience network. And when we speak to investors, they want to understand, again, these far-sighted risks and how well their portfolio companies have understood them, and can they evidence that they're resilient in the face of extreme climate shocks. So building on that theme, we obviously think that resilience is more generally defined now, and it's the process of adapting well in the face of adversity, trauma, tragedy, threats, or significant sources of stress. So climate resilience efforts encompass social, encompass economic, technological, ecological, and political strategies. So picking up on that and unpicking that for you, Emma, there's obviously this issue that everyone's talking about today around data. Today, investors are equipped with enormous repositories of data. How do they navigate through this? We no longer think that data is an impediment to progress. We're certainly seeing and hearing the investor community finding a subset of this big data using AI, using NLP, using machine learning, and navigating their way through it. So I'm just going to give you 5 points here. So today, investors are equipped with data, they're equipped with frameworks that can enable them to perform climate risk vulnerability assessments at a company and at a portfolio level based on voluntary disclosures. They can develop and implement appropriate actions and interventions as active managers across equities and fixed income. We're seeing them use and mobilize data resources to build capacity and scale up their actions. 4, we see them using data to monitor and track progress through active engagement on climate pathways towards ambitious, forward-looking climate metrics. And again, picking up the point, Carmen, I'm going to keep on coming back to Carmen at the very beginning, about engagement with outcomes. So using data to monitor and track those outcomes, very much looking at near-term targets rather than these targets out in 2030, 2050. And the 5th point here, using data to knowledge share experiences and solutions on climate and nature risk management through initiatives such as Climate Action 100+, IGCC and UNPRI. So those are the 5 points I'd make really on the data. Thank you, Emma.
Brilliant. No, thank you very much, Nita. Sorry, we mentioned kind of targets here. I know you also have a lot to say about data, so I don't know if you have perspectives on this. And also you kind of mentioned transition plans. I think it'd be good to kind of hear a little bit more about kind of what you're working on with transition plans that the financial sector should be developing and growing, and yeah, what you could maybe add to Anita's thoughts there.
Yeah, thank you. I really like the story of the forest wandering, as everyone has mentioned, and I just hope, not in an assertive way to sort of shed light on the way that we might be heading to, or hopefully would be a good idea to go to. That is the sorting out necessary data out of the floods of data that Anita has just mentioned. There are so many techniques and technologies that's for the analytical purposes, for whatever, whether or not it's risk management purposes or the outcome generation purposes. So I understand those are really important, but when it comes to the disclosure raw data, the metrics are limited, and we are not perfectly able to ask corporations or financial institutions to disclose 100 or 200 metrics to for the analytical purposes, whether or not it's risk or opportunity. So narrowing down the focus on the very important ones out of the that could be, I would say, retrieved on an engagement basis, or sometimes it's just really difficult for corporates or financial institutions to disclose any kind of data that's related to their competitiveness or product related specific data, or income generation related data, or whatever that's too secretive or too, confidential at this point. So perhaps thinking around with the basis of ISSB, of course, that's coming up hopefully soon. We might be able to sort of, think about what kind of data is really important in terms of the engagement as well as the disclosure. And so that could be sort of the prioritization activities that might be really, helpful for sort out the crowded space of data, and also in terms of transition plan, the story. When it comes to transition plan, it's just not the word somewhere out there, just without any definition, but it's going to be rather sort of the elements that could be. That could be eventually developed in a perfect, I wouldn't say imperfect, but still complete plan for a company. I recognize that GFunds as well as some other organizations have touched upon what kind of elements would sort of construct at the end of the day the transition plan for financial institutions and corporates. So I'm not specifically talking about the regulatory sort of relationship at this point, but at the same time, I think we're all aware that the transition plan is just not, it's not a plan without any concrete or evidence based or whatever, but it needs to at a certain point have I think the investors and financial institutions are looking for the elements of the transition plan to be engaged with the, with the corporates. So I guess sort of the level of detail and pragmatism that Jerry also mentioned would be sort of I would say an important sort of factor for the data space, as well as the, the transition plan, which is also included in the data, I guess.
Yeah, no, thank you very much, Rory. So yeah, Jerry, maybe I can now go to you, and I think it would be good to hear kind of how the regulator is playing into all of this, how regulation is evolving, is it supporting, is it hindering sustainable investment, and what in particular from your case is the role of central banks in driving all of this?
Thanks again, Emma. Yeah, look, I think it's a really important question for us on the regulatory side, but also for the financial system, and then the achievement of our shared goals. I think the way we at the Central Bank of Ireland think about it, and it is very much at the heart of our multi-year strategy, is there are three self-reinforcing or mutually reinforcing aspects to regulation of this. And again, I think Carmen sort of alluded a little bit to this. First of all, there are risks to the financial system and to financial firms. And in one sense, that's the most traditional thing for a financial regulator to understand and the most straightforward. But of course, when you bring climate, physical and transition risks into play, it's a whole, as we've been discussing, a whole different ballgame. But I think we've made pretty good progress in that regard. So again, if I look across the international bodies, if I look across, in my case, the European bodies, I see a lot of very helpful and pragmatic guidelines and guidance and expectations around, okay, how do you manage this? If you're a firm, if you're a financial firm, how do you manage like that first part of double materiality, the risk to you? And I think that's very important. Now, one of the things that I mentioned earlier, that we've been focused on is again, trying to demystify, trying to decomplexify, because when you look at the full range of financial firms, there's an awful lot of apprehension. Do we, small or medium-sized financial firms, do we have the wherewithal to do this? One of the things, obviously that's relevant for us in Ireland, one of the things we've produced over the course of the last 18 months has been specific guidance, in our case, in the first instance for insurers, because we thought that was a sort of a bit of a gap, where our focus has not been just really on, get this done. It's been much more around, if you're a moderate sized financial firm, if you're a smaller, if you're larger, how do you do this from a proportionality perspective? How do you come at this practically? And we created a kind of decision tree for insurers. And I think that's the type of thing that, when you get to a certain level of maturity in this discussion, is really important. That, no one's looking for perfection, rather we're looking for what works. And I think that's really important from the regulator. You also see this, for example, on the stress testing side. Stress testing, really important. Again, we're learning as we go on this. The ECB, the single supervisory banking mechanism, did some really informative stress tests. I think we learned as much from doing the stress tests as from the results themselves, and that will be taken forward. So, for example, next year we're going to have in Europe a system-wide stress test run jointly by the supervisory authority. So an awful lot in that space, which I think is practical and helpful. But of course, at the end of the day, is not going to deliver you the outcome. It's almost a sort of well, let's just make sure we're managing the worst excesses, if you like, in terms of risks to the financial system. Secondly, then from the regulatory perspective, so if we're worried about, if you like, risks to firms, we're even more worried about risks to customers and investors. So how do you make sure that in this journey, our traditional but really important concern for customers and investors is really strongly maintained? And here we're able to anchor in some of the key things that have always been there. So first of all, is a firm acting in the best interest of its customers? Right? That's at the heart of what goes on in European regulation and in certainly in the Central Bank of Ireland's regulation. Is a firm acting in the best interest of its customers? Is the advice and the products that they're providing suitable for this customer? And is there effective disclosure? In other words, disclosure that allows the investor, allows the customer to understand not just tick boxes, but to understand what they're getting. So we can anchor an awful lot of what we want to achieve in this space in those traditional aspects of what we call conduct, but it's effectively customer focused and investor focused regulation. So that's the second act. Now the third aspect, which is really the new part, and which we've had, it's been a challenge for the financial regulatory system to get its head around, which is we have a new mandate here effectively. The mandate that is coming forward from the international community and more specifically from legislators locally and regionally is we are moving to a net zero economy. And the financial system, if you want an economy, first thing you need is a financial system to fund the economic activities. So the financial system has to not only change so that it's funding a net zero economy in the coming period of time, but is actually driving that change to a net zero economy. So how do we as regulators ensure that that we're meeting our traditional risks and customer protection objectives, but also incorporating this new objective, which is that the financial system actually drives the change to a net zero economy. And that is really, really new for us as financial regulators. Now, I won't say too much longer, but just to say, I think in that third part, there's kind of three big pieces. First of all, that need for understanding the sustainability of what is being funded. It goes back to the question we've just been discussing. So the system and all of the components of the system need to understand the level of sustainability of what's been funded. Secondly, making clearly transparent the approach of one as a financial firm and the sustainability of the products you offer. And then thirdly, and I come back to this, and I will keep coming back to it, instilling confidence in investors and customers that you are in partnership with the system in getting to net zero, and that you're not more in a traditional, well, what are the opportunities to exploit here, not worrying about actually, is this a really consistent, coherent thing done with integrity to move to a new system. So those kind of those three aspects. Let me mention one final thing. Amidst all of this, and I mentioned this earlier, there's a real risk of proliferation, right? So again, as we talked about, we see it being done at the international level, at the regional level, at the local levels. So that's something for us to work on. I don't think we've cracked that. I mean, the approach taken in Europe has been right now with things like the taxonomy, the sustainable financial disclosure regulation, the other regulations. The view in Europe has been, let's drive it forward because we need to make progress, and then we need to worry about making sure that we've got coherent and consistency globally. I think that's a fair strategy. It's got lots of challenges, but we do now need to turn and make sure that, for example, it was mentioned earlier, the ISSB, the International Sustainable Standards Board, and other bodies are sorted, that we're managing to make sure we get coherence and consistency, because otherwise it falls apart because you're just trying to report to too many different frameworks. So I think, again, good progress, very challenging, and a lot to be done. Thanks.
Thank you, Jerry. I'd like to turn to some of the audience questions. I think you just answered one of them, which is whether you're in favour of convergence of disclosure frameworks. I get the sense that yes, you are. But we've had a couple of questions relating to risk, which I'll put to the panelists, and you can jump at if you want to take it. But we've had one question which is on ESG risks that are directly linked to country-specific socioeconomic conditions. So therefore, country-specific investment solutions are required to deal with this. Do we have any thoughts? Do we have any reactions to this question? We've also had a question looking at whether the SEC, I'm assuming that's the US SEC's announcement concerning the naming of funds, addresses the regulatory risk sufficiently. Who would like to put themselves forward and tackle both or one of those questions?
Maybe I can start, Emma, with the first one. Yeah, definitely. I'm glad that question was raised, because we haven't made this point, and I was planning to come back to this, that we see this at the PRI level. We have over 5,000 signatories. They're based in different jurisdictions and locations, and we have a big tent, which means that we have different investors at a different stage of the journey that Jerry mentioned earlier. Some are more advanced than others. Regulation is different in different jurisdictions, and also the data need is different depending on the country. So it's a very good point to make and not to be forgotten. And also, I like to stress that, yes, we have talked about superabundance of data, but it's also true that there is a big difference between the data that are available from large corporates, particularly the ones that are listed, and the SMEs that are mostly private, who are really struggling, not necessarily because they don't understand why they have to disclose the data, but because of a matter of resources. They may not have internally enough resources to collect the data and report them. Going back to the point I was making earlier about the burden that they're experiencing, they suffer more than others. So that's a very good point. The data vary by sector and by country. There are some common threads, but also it varies by entities. Anita was talking before about resilience, and each individual within the same sector, each individual entity may be more or less prepared or more or less aware of certain risks, and hence better equipped to address them. I just wanted to touch very briefly, and then I'll stop, on what Jerry said about pragmatism. I think in addition to pragmatism, we have to be realistic as well, because when entities set targets, it's all very well and good, and they can be ambitious, but they have to be realistic, and we need to give time to these entities, even if we are facing an emergency, to adapt. And so, a target may be very ambitious, but if the company or the sovereign, for that matter, doesn't have the necessary funding to get to that target, it may go bust along the way, and we certainly don't want to do that. And this is what I'm hoping that the credit rating agencies will be assessing more and more as more entities adopt net zero targets. And one last point on if and scenario analysis that Jerry alluded to earlier, that mentioned earlier. This is very important because data, yes, it offers a static maybe picture, and it offers a lot of information about the past, but we don't have to forget about how to model the future. And here we're all facing a huge uncertainty. Nobody's ever done this before. Even the credit rating agencies that have to backtest their data, that cannot always do that. The central banks are doing a great job with promoting stress testing in extreme cases. At the PRI also has developed an inevitable policy response scenario to educate investors about thinking what could happen if things go really badly and we crash against that wall. So these are all hypothetical exercises, but they're very, very important for investors to choose the credit relevant time horizons, but also for entities to be prepared and address these risks. So I'll stop here. Thank you.
Thank you, Carmen. Andrew, I think you'd also like to tackle the country-specific social risk. Also, there's a question on how sustainability and ESG products can help developing countries get access to affordable finance. I don't know if that's something you could also touch upon in your answer there as well.
Yeah, we can have a think about that as well. I think the point that and the question that's been raised about country-specific aspects is incredibly important. And I think a lot of the time you see a lot of Western press that seems to gloss over the fact that this is actually E, S, and G. And, the law of unintended consequences from a social perspective in quite a few developing economies can be quite severe, and to a point at which we really shouldn't expect progress to be occurring in the same type or form as we see elsewhere. Now, yes, we all have a common goal, but you have to appreciate that economic priorities and social priorities in several very large developing countries will actually outstrip environmental ones for a few years to come still. And it is important to recognize that. But saying that it's important to recognize that doesn't mean that you shouldn't do anything about it. And one of the most, it's well worth having a look at the UNPRI's inevitable policy response scenario. It really, really is a good way of looking at the differences that exist between different countries and industry sectors within different countries worldwide. We used it as the base to create a whole system of vulnerability scoring, which I think Jerry mentioned earlier, and it's really interesting to see what differences there are between industry sectors in terms of timeframes and impact from a vulnerability perspective. And you see huge differences between the coal system in China, for instance, and the coal system in Europe. And so it's really, really worthwhile taking time and looking at that. But it also plays to some of the really big differences between sectors and transitioning. And, you know, a lot of people talk about net zero, and without technological innovation for some industry sectors at the moment, which are key industry sectors and will remain in key industry sectors for decades to come, that net zero is actually going to be very, very difficult to achieve. But what you need is an ability then to measure the transition pathway and what's the best that entities can be expected to do in those circumstances. We've been spending quite a bit of time working with both large industry players and investment banks in looking at how to come up with a system for brown industries, where, you know, the requirements for the industry really are to try and avoid emissions in the first place. If you can't do that, to reduce what you're emitting. Once you get to the limit of that, then to start to mitigate what there is, maybe through capture and other aspects. And then finally, to if you really can't do any more, then to look at offsetting. And it's really, really important when you're trying to move those. Can you just remind me of the second part of the question that you added in?
How sustainability and ESG products can help developing countries access affordable finance?
I think they can, and on the basis that there's a proper understanding of the progression that needs to occur within that market. So it does link back to that country question. So, for instance, I think investors refusing to invest in certain sectors to an extent is sort of greenwashing from an investor perspective. It's easy for them to do that. But actually, it's a lot harder to say, well, actually, no, I recognize that, you know, coal has a place to play in China for the next 15 years. But what I should be doing is maybe investing with terms and conditions that require transition, and where big statements have been made, and back to the sort of science-based targets aspect of this, where companies have made statements about what their intentions are in 20 years' time. If I provide long-term funding, I can lock some of those intentions in the requirements that I have around that funding. And I think that's really where, you know, there is a big role to play in assisting developing countries. I also think the export credit agencies have a really big role to play here, and one that is perhaps being underserved at the moment. We've seen quite a lot of action from them in recent times, but I think there's a lot more that they could do to help support some of this for developing countries in particular.
Yeah, brilliant. Thank you. I'm very conscious of the time. I'm sorry. Did you have anything to add to that?
Yeah, just briefly, in response to that, I think SEC's question regarding the labeling of the regulatory sphere. Japan FSA has done the research on the I think the ESG declared sort of funds and stuff, and we are about to sort of not about to publish, but we're expected to publish the expectation to the fund managers in terms of the, you know, how to sort of you know, provide the marketing tools to the customers and the investors so that they cannot be deceivable to them. And I think the transparency is really important, going back to Andrew's point about the you know, innovation in terms of the rating agencies, as well as the evaluation on ESG data. And data. Japan FSA also has published the code of conduct, the proposal this year, and has collected all the public comments from the you know, the stakeholders. And we're not sort of preventing the innovations among the sort of the data sphere or the evaluation sphere, but we just wanted to make sure the transparency is really highly respected in terms of, you know, protection of customers' perspective. And I guess I'll leave it there so that anyone else would be able to join.
Thank you. Sorry, Anita, Jerry, do you have anything to add to this? And perhaps, as we only have a minute left, we can kind of go to closing thoughts and closing remarks. Anita, maybe I'll go to you first. Thank you.
Thank you. So just really to close, I can see we've got on 1 minute to go. So I know that you wanted to have a few suggestions on what we were thinking and expecting for COP27.
Yes.
I'll just jump to that if that's okay, because I think the panel here have covered everything. You know, certainly for us, we've spent a lot of time looking at deforestation and biodiversity loss. We really hope that maintains its presence at the COP. And I think what is really nice about the panel here today, everyone's been talking about forests. The Brazilian Amazon is the largest global rainforest on Earth, containing nearly 30% of Earth's rainforest. It's a critical ecosystem. If it tips into a savanna-like state, it could pose systemic risk, which is what the NGFS has been talking about. And it also ties back into that point we were talking today about data. We certainly see now that observational data can be used to understand how resilient these ecosystems are, but there is no net zero without negative emissions. Negative emissions come from keeping forests standing. They play a critical role in sequestering carbon out of the atmosphere. I'll leave it at that. Obviously, I've got lots of expectations for COP, but I just know that the whole panel probably wants to say something as well. Thank you.
No, excellent. And nature positive investments and solutions is something we're looking at more and more, and I think a really nice kind of thing to end on there. Carmen, final remarks and thoughts from you?
Yeah, sure. Very quickly, I've taken the liberty of putting a few web links in the chat for people to take a look at, including the PRI's position on COP27, because we're working with a number of partners. We've published 5 policy makers ask, but also a list of actions for investors to take ahead of COP27. So please do read that. My final thought is really, do engage. We haven't talked a lot about engagement. We mentioned it at the beginning of the panel. It's really important that investors engage with the issuing entities, that they don't estimate data. They talk to them. They understand the preparedness. They help them. It's really important that different stakeholders are brought into this conversation. So we want to talk to central banks. We want to talk to financial institutions, and we want to talk to the ESG data and service providers and the credit rating agencies. So we at the PRI are trying to build a program of workshops to connect the dots. We are in a privileged position to do that. So I really would like to extend an invitation to the audience who are listening. If you want to work with us, do approach us. And engagement is really the solution to close the circle and not work in silos by duplicating work. And we need to create synergies together and make progress to see the light at the end of this forest. Jerry, I'm sticking to your to your story, which I very much like, but I want to get out of this forest as well. I come from Italy, so I like sunshine. Thank you.
a great analogy, I think. Yeah, Jerry, over to you for your final remarks, final thoughts. Thank you.
So final thought for me, just in that question of COP27, I think we are in a really challenging current environment, illegal war in Ukraine, energy supply crisis, cost of living crisis in a number of many parts of the world, and huge challenges economically potentially ahead. So really importantly, that can go either way in terms of sort of providing momentum to the journey to net zero, or sort of causing our attention to drift to other things. I think for COP27, really important for all of us in this part of this conversation, that we sort of harness the lessons that we are learning, taking account of the practical need to support citizens in what's going to be a really difficult time, but that we harness the lessons to add momentum to the journey, because it's only going to get worse otherwise. Thanks.
Thank you very much. Sorry, over to you for your final reflections and remarks.
Yes, I think as everyone has sort of felt during the discussion, I think it's just, the climate sphere is from the momentum to the pragmatism. So we need a lot of good examples in terms of engagement, transitioning and transition plan development, so that financial institutions and investors can sort of review and, refine the actions in cooperation with the corporates. And from COP27 to ongoing discussion, it would be focusing around data, which is also very pragmatic or practical sort of exercise that requires narrowing down or prioritizing a lot of metrics, with the view of ISSB coming into the fora pretty soon. Thank you very much.
Thank you. And Andrew, last but not least, your final thoughts and reflections.
Sure. So I think to a point that Jerry made earlier, the pragmatism is really important. And if you think about how far this has come in just the last 5 years, and you think about the number of different participants in the market, from the regulators through to industrial entities that are working together to try and solve some of these issues, it is a huge opportunity, and it really is quite unprecedented. And it's better to try something and give it a go than to debate it and talk about it and wait to see what happens. Now, there is a caveat I will put to that, and I'm going to come back for a closing comment to use Jerry's analogy again, is that, however, time is ticking down, and if we're going to run through the forest, then we need to make sure our eyes are really wide open, because if they're not, then we're going to bump into the trees.
Yeah, absolutely. Again, I think a lovely note to finish on. So thank you so much to our panelists for joining me this morning. Really appreciate it. Thank you very much to our audience for joining us as well. And hopefully we can continue the conversation. I think we needed another half an hour, really. But thank you so much, everybody, for joining me today. And have a lovely rest of your day. And thanks to our audience as well.
Thank you,
Thank
Emma.
you.
Thank you very
Thank you all.
much.
Bye-bye.
Bye.
Thank you.